Hi, this is Keith Schneider, CEO of MarketGauge.com, and it's July 4th, 2022 edition of Market Outlook. So, interesting week. Recession fears, easing up on bonds, strong rise, and hence market stabilized towards the end of the week. So, let's take a look in detail here. So, first of all, can't really argue about the fact that the Dow, the Qs, the IWM, and the S&P all in bear phases, down quite a bit on the year, led by the NASDAQ 100, which is down close to 30%. Now, the thing that's interesting is that on Friday, when we got some additional news about the economy slowing down, putting in potential recession fears, markets stabilized and, as you can see, actually rallied along with the long bond and other parts of the yield curve. So right now, you can say with this close above all the short-term moving averages, the market sort of digested this bad news with the hope that the Fed may be on pause regarding raising interest rates. So it'll be interesting to see how this plays out. Obviously, continued bad economic news confirming a recession could put additional pressure on the markets, irregardless of what's happening with rates. So finally, concluding comments regarding equities. Obviously, we really want to see if the markets are going to have a significant bounce, taking out all these blue lines here, which is the 50-day moving average. So that is really your first line of resistance, and that 50-day also pretty closely responds to the recent highs that we had about 6 or 7 days ago. So if we can clear those levels, that would be a definite positive reaction here to recessionary fears. So now, not all the news is positive news regarding market action, and clearly one thing that is negative is the fact that this week XLU, you can see here, utilities really outperformed equities. And if you take a look here, our ratio between the S&P and utilities basically hitting new lows, therefore confirming the risk-off scenario and the flight to safety. In terms of looking at volume patterns over the last couple of weeks, things are definitely looking a bit more negative. One thing you can see, the Dow, only one accumulation day. S&P and the Russell 2000, all the same. So net volume is definitely a negative read here over the last 2 weeks. This is not surprising. I mean, take a look. Year to date, this is some of the worst performance on record going back 100 years or more, or certainly matching some of the worst periods. And this is definitely right up there with one of them. Now, what is interesting is the worst performing index, the NASDAQ, and also you can see over the last 30 days we're down over 10%. That actually over the last couple of weeks it has 3 accumulation days versus 2 distribution. So is that roaringly bullish? No, but it's certainly neutral to slightly positive. So this whole read on volume here, overall negative, but interesting that the volume patterns in the NASDAQ definitely look a bit better than the rest of the market. Now, moving on to sector summary, this is an interesting read here as well. Couple things to note. Semiconductors really got smacked, down 36% plus year to date, down over 9% for the last week alone. along with retail. Now, the other thing to note is that utilities, as we had said, also very, very strong. So for the most part, it's looking risk off. However, there is one thing that is doing better, which is healthcare, which is led by biotech, IBB, and that is definitely a spec sector. So again, a bit of a mixed read here. Obviously, spec sectors expect to get hit the worst, not the case in healthcare. So just overall, the fact is we've got a mixed read in sector summary, but for the most part, it's still a risk-off scenario. Okay, now moving on to market hotspots, which is really a global macro view. What's interesting to note is that the scenario is showing that Hong Kong actually up on the week, bucking the downtrend in equities globally. Also FXI, China, the mainland stocks also doing well for the week, positive. Now, the other thing to note, over the last 5 days, which definitely helps stabilize the market, especially on Friday, is that you can see U.S. Treasuries, TLTs, up almost 3% for the week. That is definitely helping stabilize the markets, as the rise in rates over the last 6 months has sort of been historic. At the speed and the percentage increase is some of the biggest rise in rates in history. So there you have it. The fact is that rates reversed a bit, right? And you can see here down 21% over the last 6 months in TLTs, first half of the year. However, over the last couple of days and the last week, we definitely got a reprieve, which helped stabilize the markets towards the end of the week. Now, the other thing to also note is we got a nice correction in corn, natural gas, and of course the other thing to note is that semiconductors led the indices down. It was the weakest sector, and that is definitely not a good sign overall for equities, because semis are a spec sector. All right, hope this all helps. As you can see, we've got a bit of a mixed read, although the bigger overall picture is still negative at the moment. So stay frosty, keep your stops in place, and definitely if you're a bit confused as to what to do next, please call us and we can put you on with our with Rob, who is telephone sales and very familiar with the complete market gauge lineup of products, and might be able to help you and direct you to a service that best fits your needs. All right, see you next week. Bye for now, and good luck with your trading.